are you disappointed that it's becoming more difficult to reach that high-profile return on tangible equity target that you'd previously set out?
First, let's focus on the year 2019. When we began this journey, the profitability of Barclays back in 2016 was 4.4%, a long way from our cost of capital. So we set a target of achieving a 9% return on tangible equity in 2019, and we delivered that this year. We did it by managing costs. Our costs in 2016 were £15 billion a year to run the bank. We took that down below £13.6 billion in 2019. We did that by improving revenues, all parts of our business, from Barclays UK to our international card, consumer and payments business, and our corporate investment bank. All of them generated positive jaws last year, reducing costs, raising revenues. And overall for the bank, our revenues last year were up 2%, while our costs were down 2%. That allowed us to deliver our target of 9% return on capital. It also allowed us to produce a £4.2 billion after-tax profit, which is up 12% over 2016. And along the way, we landed the highest capital print in the modern history of the bank at 13.8%.
Okay, so those are all the positives, but what about this new guidance today that reaching the 10% ROTE target is going to be more challenging? Why has it become more challenging?
When we set the targets of 9% in 2019 and 10% in 2020, that was 2 years ago. And if you look back 2 years ago, you had a very different interest rate environment than you have today, and a very different yield curve than you had today. We're maintaining our target of 10% this year, and we'll strive to achieve that, just like we did the 9% this year. But recognizing the new interest rate environment that we're under today, interest rates are significantly lower. That does put a headwind in terms of our performance, and we're just making that clear to the market. But we're standing by our 10% target. But in any event, we will see a significant, steady improvement in our profitability during the course of 2020.
So what are you doing, Jess? Good morning, by the way, from me here in Berlin. What are you doing to counter, pressure on fees, pressure on net interest margins, lower for longer rates? What measures have you taken?
Well, in Barclays UK, where there's clearly pressure on net interest margins, and also we've been quite conservative in terms of our unsecured consumer credit book, credit cards, et cetera. We do continue to increase our secured extension of consumer credit, basically mortgages. They grew by well over £1 billion in the fourth quarter. But also, we're digitizing the bank, and we added 1 million consumers on our banking app in 2019, and the services and offerings we have through our mobile bank is significantly greater than what we deliver through a branch and through paper, and that's going to improve the landscape of revenues we have in that business. But where we did also very well last year, we continue to do well, corporate and investment bank. Over the last 2 years, from 2017 to 19, the overall investment banking wallet globally has decreased by 6%. During that same time period, our investment banking revenues increased by 9%, which is a reflection of the market share that I think our investment in technology and people have enabled us to do. And in the corporate bank, we've also done a number of things that have significantly improved profitability there. So it will be more challenging, but we have very good momentum with the institution. We've significantly improved profitability every year for the last 4 years, and we hope to do that in 2020.
And as you say, you're increasing your jaws ratio. Analysts that I'm reading through say that you need to achieve a 58% cost-to-income ratio to achieve your return on tangible equity targets this year. Are you confident you can do that? And how much does a stronger pound help?
So we have reduced our cost-income ratio 4 years in a row. In 2019, we brought it down from 66% to 63%. I think as you do the math to land a 10% return, we'll need to get the cost-income ratio down to around 60%. That'll be a function of both revenues and costs, and that's what we're going to endeavor to do this year. Again, I would also focus on the capital print at 13.8%, and the fact that over the last 2 years we've now tripled our dividend as we announced our dividend at 9 pence for 2019.
Let me ask you about these other headlines then, Jez, that we see across the Bloomberg to do with your relationship with Jeffrey Epstein. What can you tell us about this new news, this new information that the FCA has launched an inquiry into your relationship with Jeffrey Epstein? What do you know about that?
So first, it's well known in the press that I have had a long-standing professional relationship with Jeffrey Epstein. It began in 2000 when I was asked to run JP Morgan's private bank, and he was already a client of the bank at that time. The investigation is actually focused on transparency of whether I was transparent with and open with the bank and with the board with respect to my relationship with Jeffrey Epstein. And indeed, it's clear in my own mind that going all the way back to 2015 when I joined Barclays, I have been very transparent with the bank and very open and willing to discuss the relationship that I had with him. And if you look at the RNS, I think what's important to note is the board has done its own review, and they've looked back at my transparency, and they concluded indeed that I have been transparent and open with the bank and with the board all along this process. And in fact, they have unanimously voted for me to be put up for re-election at the AGM meeting later this year. So full support from the chairman and from the board. But there is a regulatory process that is ongoing, and we'll let that run its course.
Okay. Do you understand, though, or is it the case that new information has come to light on which the FCA has made this decision? Why has the FCA decided to launch this probe at this time?
You know, I'm not going to go into the issues of why the FCA. I mean, clearly there's been obviously a lot of press, but I've been very transparent with the bank all along, and I think the bank has been very transparent to the FCA, and we'll just let the review by the FCA reach its conclusion.
Jess, you were talking about, to get back to the business and really, I think the interest of shareholders here, you were talking about the dividend, and I know you have a plan or at least an aim to supplement dividends with share buybacks if feasible. Is that feasible given the lower for longer interest rate environment that we're reporting on so often?
Yeah, we generate a lot of excess capital, and if you look back last year, we had, the one big impediment for us was in the third quarter when we had a charge of close to £2 billion related to the final PPI claims. We have tripled our dividend. We generate a lot of excess capital, and as we've said and we'll continue to say today, we look forward to returning more capital to shareholders, including buybacks. And when we get to the right point in time, we will announce and execute that. Let's see how it goes through the course of 2020.
Can you give us a ballpark figure? Sorry,
yeah,
as to how much? Jess, I mean, if you're not going to give me, a dollar or a pound amount, can you tell me what you want to return in terms of, a ratio?
Well, obviously, we look for the total return to our shareholders. I think our dividend yield is at a competitive level now. If you look at the year-to-date or the last 12-month movement in our stock price, we've generated roughly a 20% return pre-dividends. Any buyback, I think, needs to be significant, but also needs to be, to the extent you can, sustainable. And as we think about buybacks, we'll put it within the context of it's got to be relevant. And also, I think it helps is that it's something that you can repeat on an ongoing basis.
Can I ask you about the Brexit's latest developments and the relationship in terms of trade between the UK and the EU then, Jez? Are you worried about equivalence being taken away with short notice, or are you excited about the ability of the UK to diverge on regulation?
I think there's no question the fact that at least we've got clarity on the political outcome of Brexit has been a benefit to the markets, has been a benefit to confidence in business. I think you'll see investment begin to increase. I think also we shouldn't underestimate the impact of the government's apparent willingness to increase its fiscal deficit, provided it's to fund infrastructure and investment. We think that is a positive move forward. Obviously, we have a trade negotiation to go forth with the EU as well as with the US. We've always maintained that Barclays is prepared for a hard Brexit. We have our bank in Europe now, headquartered in Dublin, which is fully operational, so we can do everything in Europe tomorrow that we do today. We've also said, however, that when you think about equivalence, particularly in the financial industry, what the UK needs to think about is not only Europe, but very much the US. And what is the regulatory framework we face as a British bank, given our presence in the U.S. as a leading investment bank, with the regulatory framework that's being pursued by the Federal Reserve and by the U.S. Treasury. So I would keep an eye to the other side of the Atlantic as we think about issues with respect to Europe as well.
So are you excited about the prospects of diverging from a regulatory perspective from Europe?
I think being in control of the UK's regulatory environment. Clearly, the relationships with Europe are extremely important. I personally think keeping a regulatory framework globally that is roughly in line, whether it's the U.S., whether it's Asia, whether it's Europe, whether it's the UK, is healthy for a global financial system. So yeah, keeping as close as we can, but having the independence to manage its own regulatory framework, I think done right, can be a benefit for the United Kingdom.
So when you hear tough talk from Michel Barnier out of the EU, I mean, how closely are you following that? How much of your day is spent paying attention to these Brexit negotiations? There is a trade relationship ongoing today. Goods are flowing, planes are landing. So we've had our Brexit, we're out of the European Union, and the economies are functioning. I think if we've learned one thing over the last 3 years is these political negotiations around things like trade, they're never going to be settled until the very end. So we wouldn't expect some settlement over the next couple of months, but hopefully all the parties work towards a trade agreement that is productive for both the European Union and the UK by the end of the year, and we're quite hopeful and confident that that can be accomplished. Jess, thanks so much for joining us. Appreciate your time today. Jess Staley is the CEO of Barclays, talking to us after fourth quarter earnings.